Section 1. Introduction. Understanding GDP and its importance. Gross Domestic Product, or GDP, is a fundamental measure of a country's economic health. It represents the total value of all goods and services produced within a country's borders over a specific period, typically a year. GDP is a vital indicator of economic growth and is closely watched by policymakers, investors, and businesses worldwide. A rising GDP generally indicates a healthy economy with increasing production and consumption. This often leads to job creation, higher wages, and improved living standards. Conversely, a declining GDP signals economic contraction, potentially resulting in job losses, reduced consumer spending, and lower business investment. Understanding GDP is crucial for investors as it provides insights into the overall health and growth potential of an economy. By analysing GDP data, investors can make more informed decisions about where to allocate their capital. Section 2. Breaking down GDP. Consumption, investment, government spending, and net exports. GDP is calculated using a simple formula that sums up four key components: consumption, investment, government spending, and net exports. Each component plays a crucial role in driving economic activity, and understanding their individual contributions is essential for a comprehensive understanding of GDP. Consumption, or C, represents the total spending by households on goods and services. It is typically the largest component of GDP, accounting for a significant portion of overall economic activity. Investment, or I, includes spending by businesses on capital goods, such as machinery, equipment, and factories. It also includes residential and commercial construction. Investment is crucial for future economic growth as it expands the economy's productive capacity. Government spending, or G, represents the total spending by all levels of government on goods and services, including defense, education, and infrastructure. Government spending can significantly impact economic growth, particularly during economic downturns. Net exports, or NX, represent the difference between a country's exports and imports. A positive net exports figure indicates that a country is exporting more than it imports, contributing to economic growth. Section 3. Consumption. The heart of economic activity. Consumption is the lifeblood of any economy, representing the largest component of GDP in most countries. When consumers are confident about the economy, they tend to spend more on goods and services, driving economic growth. This increased demand encourages businesses to produce more, hire more workers, and invest in expansion. Factors influencing consumer spending include income levels, employment rates, interest rates, and consumer confidence. For instance, during periods of economic expansion, when unemployment is low and wages are rising, consumers are more likely to spend, boosting GDP growth. However, economic downturns can significantly impact consumer spending. Job losses, wage cuts, and uncertainty about the future can lead to a decline in consumer confidence and reduced spending. This decline in consumption can further exacerbate economic contraction. Section 4. Investment, fueling future growth. Investment is crucial for long-term economic growth as it expands an economy's productive capacity. When businesses invest in new factories, equipment, and technologies, they can produce more goods and services, leading to higher GDP. investment is influenced by factors such as interest rates, business confidence, and technological advancements. Low interest rates, for example, can encourage businesses to borrow money for investment purposes, boosting economic growth. Government policies can also play a role in stimulating investment. Tax incentives, subsidies, and infrastructure investments can create a more favorable environment for businesses to invest and expand their operations. Section 5. Government spending. A balancing act. Government spending is a double-edged sword in its impact on GDP. On the one hand, it can stimulate economic activity, particularly during economic downturns. Government spending on infrastructure projects, for instance, can create jobs and boost demand for goods and services. On the other hand, excessive government spending can lead to higher budget deficits and national debt, potentially crowding out private investment and hindering long-term economic growth. Therefore, governments face a delicate balancing act in managing their spending levels to promote economic growth without jeopardizing fiscal sustainability. The effectiveness of government spending in stimulating GDP growth depends on how the money is spent. Investments in education, infrastructure, and research and development tend to have a higher multiplier effect, generating greater economic returns over the long term. Section 6. Net exports, the global trade impact. Net exports represent the difference between a country's exports and imports. When a country exports more than it imports, it has a trade surplus, which contributes positively to GDP. Conversely, a trade deficit, where imports exceed exports, detracts from GDP. Factors influencing net exports include exchange rates, global demand, and trade policies. A weaker domestic currency, for instance, can make a country's exports more competitive in foreign markets, boosting net exports. Trade agreements and tariffs can also significantly impact net exports. Trade agreements can reduce trade barriers and promote trade between countries, while tariffs can increase the cost of imported goods, potentially reducing imports and boosting net exports. Section 7. GDP's influence on Forex and gold markets. GDP is a key driver of currency exchange rates in the Forex market. A strong and growing GDP typically leads to a stronger currency, as investors are attracted to the higher returns and economic stability offered by a thriving economy. Conversely, a weak or contracting GDP can lead to a weaker currency, as investors lose confidence and seek better opportunities elsewhere. For example, if the United States experiences robust GDP growth, while the Eurozone struggles with economic stagnation, the US dollar is likely to strengthen against the euro. This is because investors will be more inclined to invest in the US, increasing demand for the US dollar and driving up its value relative to the euro. Gold, often considered a safe haven asset, tends to have an inverse relationship with GDP. During periods of economic uncertainty or recession, when GDP growth is slowing or contracting, investors often flock to gold as a store of value, driving up its price. Conversely, when economies are strong and GDP is growing, investors may shift their focus to riskier assets like stocks, potentially leading to a decline in gold prices. Section 8. Conclusion. GDP as an investor's guide. GDP is a crucial economic indicator that provides valuable insights into the health and growth potential of an economy. By understanding the components of GDP and their interplay, investors can gain a deeper understanding of the forces driving economic activity. A strong and growing GDP typically translates into a favorable environment for businesses and investors, leading to higher corporate profits, increased stock market valuations, and a stronger currency. Conversely, a weak or contracting GDP can signal economic trouble, potentially leading to lower investment returns, currency depreciation, and a flight to safe haven assets like gold. By closely monitoring GDP data and analyzing its trends, investors can make more informed investment decisions, allocating their capital to assets and markets that are best positioned to benefit from the prevailing economic conditions. While GDP alone is not a perfect predictor of future economic performance, it remains an essential tool for investors seeking to navigate the complexities of the global economy.